Hi, and welcome to a special edition of a weekend equities and fixed income trend view video analysis, along with the separate foreign exchange trend view that we will be posting. This is part of an overall global view, and we based both of those on the closes from Friday, January 15th, 2016. And there were just longer term implications for each of the asset classes from the last 2 weeks that we wanted to make sure and explore a bit, and it just was better to break these up into two somewhat shorter video analyses. The macro discussion is part of this analysis. We'll get to that momentarily. It is not repeated in the foreign exchange special weekend edition. And of course, one of the key aspects of the macro analysis is the still weak crude oil that speaks of weak energy and commodity prices. That is quite a driver for the current weakness of the equities and strength of the govies. So now we have to ask ourselves, what has all this meant to the markets? And you can see how the S&P 500 future that had based out at about the 1872 level on Thursday and pushed all the way back up to the failed up break and low end of the already existing 1925 to 32 range. Looked like it closed pretty well on Thursday and opened absolutely abysmally on Friday, opening below the key low from Thursday and not able to hold its ranging back above 1872, ultimately making its way down to 1850 before a late session recovery. Now, all of this is very important because, as we've been pointing out for a while and is apparent on these Fibonacci retracements, there were key previous lows in the March contract and a very major long-term support in the 1865 to 60 area. So we're going to be keeping a very close eye on this as we head into the new week. To really exert any strength, this looks like it probably has to be back above the upside reversal it failed. That was from late session on Wednesday into the early trading on Thursday, and that was from about the 1880 area, low 1880s. Much above that, it might range well back above 1900 again. Much below 1865 to 60, the next supports, even though it held with some slippage on Friday and recovered, are actually into 1831. That was the August lead contract low on the Chinese currency scare, and 1813, that was the October of 2014 Ebola epidemic scare low before the markets pushed back up. And that pretty much does it for the short-term view of the S&P 500. This might take a second to populate. There it is. And the reason this is so important is you can see your failure here out of that more aggressive channel. This was the overall upward channel, and this is on the weekly chart as well. It's just easier to see it on the monthly chart. The overall upward channel since the significant reaction low at 1068 in October of 2011 that the market held at various subsequent times, including that Ebola scare back in October of 14. This isn't drawn here because that low was left. This channel was in place before it got there based on how the market had topped out on the way up. But going out into August, it finally cracked it, squeezed out of the bears above it, and then turned bad again. What's important about this, again, we repeated it on this scope of chart, this 1866 Fibonacci level and the trading low at 1862 from September, is that is also right in line with the more major, broader, the overall broadest upward channel since the March 09 major cyclical low on the follow-through out of the 2008 crisis and market meltdown. This for the low at 666. They say the devil's in the details, and certainly the bears got burned from there for a long trend up based on all of the QE and other factors. Now we're challenging whether that is still in place, and it is most interesting we're doing it at a time when there's consideration of whether all the QE has really amounted to anything that would reinvigorate the global economy. And that pretty much does it for the S&P 500.